Hey, everybody, we're going to talk ETFs today. Not every investment has to be individual stocks. I've been buying more ETFs in my own portfolio this year than I normally do, just because I see some good kind of broad opportunities to put money to work. It sounds like my friend Tyler does too. So we are going to talk about some of our favorite ETFs right now. Before we dive in, take a minute and check out fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. And it's the best way to support this work we are doing on YouTube. So again, check out fool.com/Frankel. So I'm going to go ahead and kick it off. I said at the beginning of 2024 that small cap stocks in general were a very good opportunity right now. They've underperformed the large cap counterparts for a long time. Um, Most of the market's returns, when you see the S&P's hit an all-time high, the Nasdaq's hit an all-time high, the Dow's hit an all-time high. Most of that's been fueled by the big cap tech stocks. When a giant company like Nvidia doubles in a short amount of time, it's going to disproportionately contribute to the market's performance. And we're seeing that from a lot of the bigger companies. Just to kind of give you a statistic right now, the average PE, and I'm actually surprised it's this high, the average PE of an S&P 500 stock is over 26 to 1 right now. So 26 times earnings, the average S&P 500 component trades for. The average small cap, so the average company in the S&P 600, the small cap 600, has an 18 times price to earnings multiple. Pretty big gap there. And that's not just the big tech stocks that are at the 26. A lot of them are well over that mark right now. So big valuation gap. Small caps are trading at their lowest price to book valuations relative to large caps since 1999. 25 years since we've seen this gap. And by the way, last time we saw this much of a valuation gap, small caps outperformed for about the next decade by a significant amount. So I think that small caps could be a big beneficiary of interest rate reduction as interest rates normalize, hopefully over the next few years. Small caps are just in general more likely than large caps to have debt on their balance sheet, so they're a little more rate sensitive. And that way, as a whole, small caps are the companies that people will pull back on when their appetite for speculation falls when rates are higher. If you can get 5%, just simplified example, if you can get 5% interest from a 2-year treasury, it might not be that appealing to add some small cap stocks to your portfolio, but you might leave your S&P 500 ETF alone. So people tend to kind of sell small caps in rising rate environments to a greater extent than large caps, just as a whole. So I want to quickly share a screen. There we go. So this is a 3-year chart of large caps versus small caps. This is the Vanguard S&P 500 ETF versus the Vanguard Small Cap ETF, which is the one I think is a great buy now. The symbol on that is VB, by the way. I'll repeat that a couple times. But you can see over the past 3 years, the S&P 500 ETF has returned 21% gains, whereas the small cap ETF is down by about 2.5%. So that's over the past 3 years. And I said this was a great valuation gap to take advantage of at the beginning of the year. And the fact that the Fed has kind of extended expectations for falling rates has kind of even made this a bigger gap. So year to date, the S&P 500 is about 4.5 percentage points above the small cap ETF. So the gap has widened even since I said that it was a great opportunity for long-term investors to get some small cap exposure in their portfolio. I think that is still very true today. So the Vanguard Small Cap ETF, again, ticker symbol is VB. It is not a very concentrated ETF. No more than 0.4% of its assets are in any one stock. It has over 1,400 small caps. It's a really great way just to get broad exposure. Unlike an S&P 500 ETF where 30% of its exposure is to just 7 stocks. So again, VB, I think it is a really good time to buy in, that the Fed kind of gave small cap investors a gift by extending expectations of falling rates. And now is a great time to take advantage. Tyler?
So I think I may have mentioned this one before, but I'm going to go back to the well because I still think it's one of the better ideas I have right now, and that's
One of the better ticker
the
symbols in the market too.
yeah. It's it it's funny. I don't know if it was good. It certainly doesn't inspire confidence, but I'm looking at the iShares MSCI Mexico ETF. The ticker is EWW. So ew. I know it kind of stinks as a ticker. But here's where, for me, at least things get interesting. And this is kind of the thesis I've been building around the concept of investing in Mexico. Um, we have seen there's been a few things over the past few years that have made Mexico a much more attractive market in general. We had the updated rules related to NAFTA, so the U.S. MCA agreement, which improved kind of the mechanics between manufacturing in Mexico. We've seen a post COVID, we've seen a very large shift in kind of uh, we'll call it like uh, executives trying to diversify their supply chains or nearshoring, friendshoring, whatever the heck you want to call. Hey, let's not manufacture everything in China. It's just a nice euphemism for that. And Mexico has been one of the largest beneficiaries in terms of like labor costs. Mexico is very much on par with a lot of the other Southeast Asian manufacturing centers outside of China on cost, and also benefits immensely from things like cheaper transportation costs, cheaper real estate costs, cheaper energy costs. Natural gas pipelines from the United States, piping all that cheap gas out of the Permian, has given Mexico a huge energy advantage. So, like high energy industrial manufacturing can be done at a pretty good rates in Mexico relative to a more energy dependent country that's, I don't know, importing LNG at triple the cost. So Mexico in general, and you're starting to see the early signs of this if you look into the Mexican market. A lot of the companies right now that are absolutely booming in this industry, on the Mexican market right now, are like industrial real estate REITs. Real estate construction companies, finance companies, airports, transportation, logistics. These are the businesses right now that are thriving in Mexico. And if you look at the Mexican stock market, it's quite small. It's completely devoid of tech. So a kind of an interesting little tidbit there. It's basically all banks, consumer goods, and construction. Uh, But despite the fact that devoid tech and all the boom in AI over the past 3 years, excuse me, over the past 3 years, the Mexico ETF has actually grown on a total return basis by 57% relative to the S&P 500's return of 26.9. So you're looking at a kind of an old stodgy industry market putting up monster returns. And my thesis also is that with construction booming, you're going to start to see an uplift in economic growth and kind of like people moving up the socioeconomic ladder. So that starts to impact your consumer good companies. That starts to impact a lot of the other parts of the Mexican market that are going to start to feel these effects. And because of this, to me it looks quite attractive. It has a dividend yield on the ETF of about 2.2%. The price to earnings ratio is considerably lower than the price to earnings ratio for the S&P 500, although understandably so, kind of based on the markets. And it only has an expense ratio of 0.5%, which is considerably higher than what you get for an S&P 500 index fund, but not completely unreasonable because for a lot of Mexican companies, not a lot of us have the ability to trade international stocks in our portfolio, and so you get an ETF that kind of covers all of your international stock buying without actually having to all the commissions and the wonky things that come with it.
See, I like the Mexican. I like the opportunities in Mexico right now. Just kind of anecdotally, I was reading Mercado Libre's earnings yesterday because it's one of the companies I cover and one that I'm heavily invested in. And Mexico is their fastest growing market. Um, I have to believe there's something to that kind of relates to what you're talking about with the opportunities there, and that it's just like it's really rapidly like adopting e-commerce, and there's a lot of big growth opportunities there. It's adopting electronic payments at a greater pace than a lot of other countries, and it's underappreciated right now as an opportunity. So I like that one. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.